Ever watched your stock hit a high and then crash back down before you locked in a dime of profit? Well, you're not alone, and that's exactly what trailing stops are built to provide. So in this video, I'll show you how to use them to protect your gains, limit your losses, and stop second guessing every trade. Because the real danger isn't a bad investment, it's not having an exit plan. So ever sold a stock too soon or watched profits vanish because you didn't have a plan? Well, that's why trailing stops exist. You can think of them like a smart safety net that moves up as your stock rises, letting you keep your gains and lower your risk. Now, unlike regular stop losses, trailing stops don't stay rooted to one price. They trail right behind your stock as it climbs, automatically adjusting to lock in profits or avoid additional losses. All right, so how does a trailing stop actually work behind the scenes? So let's go ahead and picture this, right? You buy shares of a company at $100, feeling pretty good about your choice. You decide to put in a trailing stop set at 10%. This means that if your stock goes up to 120, your trailing stop also climbs, and at that point, it would only trigger if you lost 10%, or $12. But a cool part of this is that if the stock keeps rallying, that stop chases the price upward, always keeping you within 10% from the top. But here's the awesome part. That stop only moves up when your stock goes up, not when it falls. So if the shares slip, that stop stays put. And using those numbers we just talked about, let's say that the stock price is at 120, that means that the stock price would have to fall all the way down to 108 in order to trigger the trailing stop. But once it does hit, you're out, right? With most of your gains locked right in. There's no need to watch the screen all day or panic sell at the wrong moment. The order takes care of it automatically.
But keep in mind, during fast drops, you might not get filled at your exact stop price, especially in low liquidity stocks.
Yeah, this is exactly right. And in some instances with meme stocks or really highly active stocks, the exchanges they are listed on may put a pause on your ability to make a transaction as well. But not all trailing stops are created equal. You've actually got two ways to set them up, and the difference can completely change how well your strategy works. Now, when it comes to trailing stops, right, you've got two choices. So set it to follow your stock by a fixed dollar amount or by a percentage. But here's the thing. Percentages are usually the smarter move, especially when you're dealing with stocks that bounce around a lot. Right? With a percentage trailing stop, your safety net adjusts to fit your stock's price, which is crucial to take emotions out of it. And to be clear, that emotion-free zone is where good investing usually happens. So subscribe to the channel if that's a mindset that you want to build, as I do my absolute best to give strategies where emotions just don't matter. But as an example of percentages versus dollars, a $5 trailing stop on a $25 stock is way more aggressive than on a $200 stock. A 10% trailing stop, on the other hand, fits any price point and works the same whether your investment doubles or hovers just above your buy price. That's why seasoned investors stick with percentages. They're more flexible and help you manage risk across different stocks without second guessing every order. So how does this whole thing give you the upper hand when stocks swing hard? Well, here's why trailing stops are the go-to for so many investors. So if you've ever felt uncertain about when to cash out or worried about losing hard-earned profits, trailing stops are the answer. The biggest perk? Trailing stops help take the emotion and guesswork out of selling. Instead of trying to time the market, which, let's be honest, nobody really gets right most of the time, your trailing stop automatically captures your gains and you can set it and walk away. Now, I prefer it myself as well because it's so much easier to be comfortable with selling on a 10% drop from a peak, because most likely you hit the peak price of the stock and we'll have to keep an eye on it as things, adjust from there. Now, if you're feeling more confident about using trailing stops, that's awesome. But there's more to keep in mind as an investor. So click right over here to the next video where I share the top 7 mistakes every new stock investor makes that you can avoid if you're aware of the trap. So go ahead and check it out.